Hello everyone, Clifford, Bennett, Chief Economist at ACY Securities, and I want to let you in on a big secret. Wait for it. I just gave the best video of my life and I hadn't turned the camera on. It happens to the best of us, but hey, I'm a nutty professor, so that's allowed. What I was talking about, so excited about for you, was this, that the whole market is focused on a lower inflation number coming out of the US in a day or two. And that inflation number around 6.7 to 6.5%, they're hoping, I think it could be 6.8 or 6.9, coming down from 7.1 on the previous number. They're hoping will mean, actually, they're not hoping. They actually fervently believe that a lower inflation number will somehow miraculously change the Fed's mind, because somehow that will be a surprise to the Federal Reserve. They're expecting lower inflation and they're still aiming to raise interest rates. It is completely inaccurate to think that a lower inflation number is going to somehow hasten the Federal Reserve of the US slowing interest rates. They are already slowing. They're dropping to 50-point increments, but they will stay there for 2, 3, 4, or 5 meetings. That's still whopping increases. I'm more hawkish than most, but even if they hike another 2 or 3 meetings, that's still way beyond market pricing and expectations. The market is wrong. The market was wrong last year, thinking that, making all-time historic highs in the first week of January last year, when I said the market's going to fall 20% this year, which it did. The market has it wrong again. The market is thinking that terrible economic data, as we've been seeing, for instance, with the ISM PMI for services going into contraction. That's most of the US economy going into contraction. But hey, let's not pay attention to that. Let's just spin that into the upside of, terrible economic data, that'll help the Fed slow. As if the only thing that drives stock market prices is interest rates. Hello, can I hit anyone who thinks that very hard on the head with a basketball? There you have it. Economic violence. Really, it's not. It's reacting from the economy. People say, but there's a correlation. If interest rates go up, stock markets go down. And if interest rates go down, stock markets go up. Yes, 50% of the time historically. This is the worst misnomer and sort of false belief in markets, and always has been. The correlation is 50% between interest rates and stock market prices historically. You know why? Because usually they're both responding to the same stimuli. That is the core economy. If the economy is strong, people are able to raise prices, you have inflation. If the economy is too strong, and because they're able to raise prices, they have higher earnings, so stock prices go up. But if it's too strong, the Federal Reserve or the central bank of any particular country jumps in, starts to raise interest rates with the idea being dampen demand so price inflation doesn't get out of control, because the worst thing that can happen to an economy is inflation, and the US has the very worst thing at extreme levels. Even with declines over the next 1, 2, or 3 months, there's still extreme inflation levels damaging the US economy. The US economy is in dire straits. As I said, most of the US economy was already in recession, heading into recession in December 2022. Again, because we did have technical recession in the first half of last year. And in the first 9 months of the year, the US economy grew by 0.4%. Yeah, great reason for markets to celebrate. Markets had been going up because of near zero interest rates. Hey, we don't have that anymore. And because of massive government stimulus. Hey, we don't have that anymore. But for some reason, people got used to the idea that stocks will go up. In fact, I think people believe in the idea that stocks will always go up in the same way that they believe there is a sky and an earth. They think it's a given. It's not. In 1929, if you bought US stocks, how long did you have to wait for a profit before they got back to the same level? 25 years. So yes, stocks always go up, but it can take 25 years. Now, I said last year, December of the previous year, starting last year, that this was either going to be a 6 to 18 month correction of 20 to 30%, or it was going to be a 3 to 6 year correction of 40 to 60%. And that's what it could still be. But for the moment, everyone's excited because the inflation number is going to go down. As if any other trader and investor who you're competing with doesn't know that as well. So how are you being clever? Who are you outsmarting? You're not outsmarting the Federal Reserve that they're going to stop raising interest rates suddenly because inflation drops even to 6.2%. They're not going to stop raising interest rates. So why are people excited about a 6.7 or a 6.5 number? Seriously, 5.8%, if the Fed thinks it's still stubborn inflation, and there are a lot of pipeline price pressures yet to come through, so inflation is going to be stubborn, they will still be hiking interest rates. Fed Chairman Powell gave a speech in Stockholm yesterday, and he said, we're going to keep doing the unpopular thing. I mean, how many times does he have to tell people? But yet they go, oh, if inflation's falling, if the economy's crashing, they're going to stop raising interest rates. Only if inflation is heading back to their target, and that's a long way away. They will slow down. They will plateau. They will not pivot. That was the biggest joke of 2022, and it seems to be persisting in 2023. It's the same as the flat Earth people. It's a clever sounding argument, but the Earth isn't flat. It's a clever sounding argument that the Fed will pivot, but they won't. And they've already told people. I mean, the people who think the Fed's going to pivot are the same people that thought inflation was transitory. And remember, when the Fed was saying inflation's transitory and we're going to keep interest rates low, and the RBA was saying, yes, inflation's definitely transitory, and anyway, global inflation will never come to Australia, and we're going to keep interest rates low till 2024, which is what they said, almost verbatim. I said, they don't know it yet, but they're going to change their minds, and they're going to be hiking interest rates. And they were. But at that time, there was a big group think that said, yes, the Fed's right. Inflation's transitory. Interest rates going to stay low a long time, so buy stocks. Now they're saying, oh, the Fed got it wrong. Where's their mea culpa? The Fed got it wrong, and they're raising rates, and now they're going to get it wrong again, and they're going to raise rates too far, and there's going to be this big pivot, and they're going to have to cut rates savagely to support the economy. No. No, they won't. And even if you argue they should, and I'm open to the idea that they should, they won't. They're going to plateau. They're going to hold because they want inflation back at 2 and 3%. They don't want it back at 6.7, 6.5, 6.2. They want it back at 2 and 3%. That's a long way away. They will raise rates until they see it really crushing the economy, really crushing employment, and then they will wait for inflation to come down on that basis. So we're still a way off from that. So yes, the inflation number will be lower. No, the Fed will not be slowing raising rates because of that inflation number. Ta-da! That's really the situation. Yet, everyone believes the false premise, so everyone is making sure they're long going into the inflation number. That means when everyone who wants to buy has bought, and those who followed me for years will know, that means they themselves have become nothing but a sea of potential sellers. Now, I expect when the inflation number comes up, say it comes out at 6.4, market jumps higher, leaps higher. It might go higher for 1, 2, 3 days, one of those rallies, or it might only go higher for a few hours, 6 hours, 12 hours. When the market starts to fall back in on itself, all of the day trading, all of the professional hedge fund investment community are going to want to sell. Because, particularly the professional traders, because they know this US economy, this global economy is going to get much worse, more than people anticipate, and more than is priced into markets. Therefore, stocks which are driven by earnings are highly overvalued at current levels, and they're going to get a little more overvalued before they tank. Now, I can be wrong, but if I were you and I were a trader investor, I'd consider that scenario quite seriously. So everyone's getting long into the inflation number. What happens when a company has a good earnings report and everyone expected a good earnings report? Usually, the news comes out, the market gets priced higher, it lingers, and then it crashes. Why? Because everyone who wanted to buy it already bought. That's why, and they now need to sell. The same thing is happening here with regard to US stocks generally, with regard to a lot of stock markets around the world, but particularly the US stock market. So therefore, if I'm wrong, just enjoy being long. But if you see the market begin to turn around and fall back in on itself in a significant way, that will be a major sell signal for the rest of 2023. Thanks very much. Have a great day. Clifford Bennett, Chief Economist, ACY Securities.